24/7. My name is Niharika Walia Bhatnagar and I'm with you with the area of ABFM. Okay, everyone, first of all, please share the session, like this session, and don't forget to subscribe to our channel if you haven't done it yet. What are we dealing with today? We have started with the area of capital investment decisions. So today I'm going to continue further regarding the project appraisals and the specific topics regarding non-discounted methods. So slowly and steadily we'll be finishing it off this as well. This is an important topic. This is the base level topic for all the vital topics that we'll be covering further. So it's a very, very important area because this becomes the base for other topics as well. In the module C and in the module B, it plays a very important role. That means we're looking at victory series now, everyone. Okay, here comes the first question, everyone. A capital budgeting technique which does not require the computation of cost of capital for decision making process is NPV, IRR, MIRR or payback. Capital budgeting which does not require the computation of cost of capital. What's going to be the answer, everyone? The answer to this question is going to be payback period. They're not worried about cost of capital. It is actually worried about the number of years in which we'll be able to recover the amount. Okay? That is covered as payback period. Done? Chaliye, let's look at the next question, everyone. IRR method would favor project proposals which have what? Internal rate of return. This is the rate at which your net present value is actually zero. That means whatever PV of cash flows is available, it is the same as that of the initial investment that you made. If you spent 10 lakh, you are getting your 10 lakh back. That is covered under the area of PV of cash flows. Done? So in this case, heavy cash inflows in the early stages, evenly distributed cash inflows throughout the project, heavy cash inflows at the later stages, or none of the above. What's going to be the answer, everyone? Everyone? Chaliye, what's going to be the answer? Internal rate of return is related to heavy cash inflows in the beginning and slowly and steadily it reduces because of the area of the cost of capital is basically something. If you look at the particular cash flows now, when you're trying to find present value now, it is higher when we are talking about the years just few years from now. Matlab, if it is 0 year today, first year, second year, third year, the PV will be higher. Once we look at 4th year, 5th year, 10th year, the PV of the cash flows goes down and down. Okay? Now, next point. Which principle suggests estimating costs separately for activities that would be incurred whether or not the project is run? Consistency principle, incremental principle, marginal principle, or post-tax principle? Whether or not the project is run. See, we're looking at the project if it is running or if it is not running. then the answer should be incremental principle. If we keep on working on that particular project, then how much increase are we having? If we just stop right here, then the amount will also stop now, isn't it? Till the time the amount is defined, this is what we'll receive, this is what we'll pay, then things are different. If it is not defined, then done. Chaliye, let's look at the next question. Why is it advisable to consider post-tax cash flows when estimating project cash flows? See, till the time we are finding this particular value, we should know what is post-tax value. Post-tax value matlab after we have considered tax, what is the value after it? Because we have already paid tax, and this is what is important to us. Taxation cannot be removed from the Indian structure. Indian taxation structure has tax. That means whenever we are looking at a particular project, we cannot keep our eyes shut towards the area of tax deductibility and tax calculation. It is very important that we know about tax deductibility as well as tax calculation. Whether we should go for the project based upon tax or not. Because post-tax cash flows are always higher than pre-tax. Because ignoring taxes may lead to unreliable discount rates. Because post-tax cash flows are easier to calculate because post-tax are exempt from financial regulations. What's going to be the answer, everyone? I think if I take the post-tax, then it is correct. Otherwise, whatever I'm getting, that is the wrong cash flows. The wrong cash flows will give us the wrong discount even. You know? Isn't it? So, what's going to be the answer? The answer is going to be because ignoring tax will give us unreliable discount rates. So, discount rates will not be justified. So, in this case, it has to be considered properly because one specific wrong decision is going to affect our inflows and even the solvency of the organization. What is solvency, everyone? Ability to repay. It can even it can even affect the ability to repay the amounts as well. है ना? Done, everyone? Chaliye, let's look at the next question. Chaliye. Next question says, which factor guides the forecasting of fixed assets requirement in a project? If I'm looking at the fixed asset, whether I should buy the fixed asset or not will depend upon what? Duration of the working capital requirement, matlab what is the capital that we require on the regular basis. Then business advances and gap between statutory dues and payments. Then duration of the project, whether we are looking at the fixed asset or not, and requirements of assets like land, building, machinery, etc. The answer is requirement of assets like land, building, machinery. That has to be considered. Then chaliye, let's look at the next point. What aspect does the payback period method ignore? Cash flow beyond the payback period, initial investment amount, time value of money, or profit maximization. When it looks at the basic thing, it actually ignores multiple things. Cash flow beyond the payback period is not recorded in it at all. It is worried about Bhagwan in how much time I'm recovering the amount. They're so worried about the recovery that they don't even care what happens after the project recovered amount is done. Maybe your recovery is lower, but after that you made immense amount. then I believe the payback period will not matter because I'll get an immense amount in the upcoming future. So cash flow beyond the payback, initial investment, time value of money or profit maximization. It is cash flow beyond the payback period. Even when the payback period is over, na, even then you can see it. That particular part is not a part of it, the payback period. It has a limited horizon in terms of studies in this area. It is very much limited. Done? चलिए. When is the payback period method suitable? When is this payback period method suitable, everyone? For large scale business, for the projects with uncertain cash flows, for small businesses which are not feasible or projects requiring extensive scientific analysis. But in terms of payback period, na, your horizon is not broadening up. You are just worried about ki in how much time I'm recovering the amount. Maybe you have taken the amount in such a hurry or you have committed such big amounts that you are supposed to pay them back. Otherwise, your business will fail. So then you are just worried about in how much time I can repay the debt. You're not worrying about what growth you have, what extensive areas are opening up for you, what branches are there for you. All those things will not come up. है ना? So the payback period is for small businesses where it is not worth spending more time and money. It's not really something which we are worrying about in how much time I will be recovering the money. All those things are not required. Payback period is very, very limited to one particular area and how much time I am recovering the amount. Okay? How does the length of the payback period relate to the risk and probability? Longer the payback indicates lower risk, longer payback indicates higher, shorter payback indicates lower risk or shorter payback indicates higher. See, if I give you 10,000 rupees today and within 2-3 days you're giving me back, the risk is least. Isn't it? The risk will affect us because you will look forward to it in terms of future. Na? In this case, if we are recovering it in a very small period of time, in a very short span, then we won't be worried about it. है ना? चलिए, this was about the specific area altogether. Let's look at the next question, everyone. In what type of budgeting exercise is the payback period method typically used? Small scale industries, then we have the large scale in the budgeting exercises, or medium or strategic. When you're looking at totally the budgeting, na, payback period has a very limited horizon. It's just looking at in how much time I'm recovering the money, and that's it. Recovery is the only thing they're thinking about. So in this case, small scale budgeting exercises is the answer. Done? Which of the following statements about the payback period method is true? It is extensively used in larger size capital budgeting decisions. It considers cash flow beyond the payback. It provides a detailed analysis of the project profitability, or it is simple concept suitable for small business. Payback is basically a very simple project where looking at in how much time I'm recovering the money. It doesn't look, I'm sorry, beyond the horizon. It's not looking at in how much time I can recover the funds, what greater things can be brought out of it. All those things is something which is just not relevant in terms of payback period. It's just worried about in how much time I recover the funds. So I can say this is for small businesses. They're just stuck with the era of small business, and that's it. They're not trying to learn what bigger can come out of it. They're not looking at anything else but just the point of small. Okay? Because they are just recovering the funds. Na? the growth, the overall long-term longevity of your business, those things are not a area of concern for them. Done. Then comes, why does the accounting rate of return method score over other methods? ARR method is actually an accounting area. It requires estimates for the entire project life. It is a profit centric and not cash flow centric. It involves complex calculation that is based on accounting information readily available and familiar to the business community. What's going to be the answer, everyone? What's going to be the answer? Accounting rate of return is actuated to the percentage of return that we are getting. And that is it. It is just limited to the area of how much amount are we getting as a return. This will determine the feasibility of the project. ठीक है ना? Feasibility of the project, whether the project is worth it or not. That is to be decided based upon the accounting rate of return. Accounting rate of return uses average investment and the returns. Done. Then comes the next question. What limitation of ARR method have? It is a cash flow centric and not profit centric. It does not take into consideration the account time value of money. Whereas it does not. Then it requires estimates of the entire project life. Yes, because we need the entire project area. And it involves fewer uncertainties compared to other. We say one particular truth about it is just it is actually just looking at everything, but not from the futuristic point of view and how much time we are recovering funds and all. It's not their headache. So they just say it does not take into account the time value of money. While time value of money plays a very, very important role. है ना? Then I don't know what is the time value of money. How will I move forward to this? So that's the answer. Then why does the discounted cash flow method pose challenges compared to accounting rate of return? Discounting cash flow is basically a difficult topic as well. It requires major calculations. Then it is profit centric and not cash flow centric. It is actually based upon time value. So it is not about profit or cash flow. It requires limited data. It calls for estimate of the entire life, making it more uncertain. Because you are giving an estimation, sir, what will happen in the future. Then it uses accounting information readily available and familiar to the business community. If you get into this field, then you will understand having a readily available information might not be required by you because this is not customized for you. While for every organization, the customization is compulsory. So in this case, the answer would be it cannot be doing for the entire project. When we're trying to find it for the entire project, it becomes difficult. So it calls for an estimate for the entire project life, making it more uncertain. Everyone, if you haven't subscribed to our channel yet, then hurry up and subscribe it. For CAIIB, we are coming up with so many things. So make sure you're utilizing your time to the maximum level, coming up in our classes and attending all those courses there. But before I end my session, everyone, I hope you have reviewed our courses as well. Let's go and see our website. This is our website, everyone, www.adda247.com. Go on to the specific area. Go on to the area of JIB and CIB. Go on to the area of CIB June 2024. Once you go on to this area, CIB Mahapacks, it is available at double validity. Pay for 6 months, you get it for 12 months. There's nothing better than having it for 12 months, everyone. In the entire CIB courses, bilingual, English medium, compulsory subjects, and even the optional subjects, all optional. There's no specific one that you have to choose to pay. You will get all of them. Test series, ebooks, everything available. So all you need to do is use the code Y541 and apply it. We'll get it for 6499 everyone. Okay, the maximum discount is available, so kindly check it out on our website and our app for further details, and I'll be meeting you tomorrow at the same time. So have a nice day. Thank you so much for being there. Bye bye and take care.